What's up, guys, and welcome to Technical Indicators 101. Have you ever wondered what the RSI is and how it works? Well, in today's exercise, we're going to do just that. We'll take a look at the RSI, aka Relative Strength Index, and talk about what it is, how it works, and how you can apply it when analyzing the markets for possible entry or exit signals. This tutorial is going to be designed for traders and investors who are just beginning to dive into the markets and they're looking to increase their knowledge and understanding of chart analysis and technical indicators. It'll be our first installment of our Technical Indicators 101 series, so let's not waste any more time and dive right in. Let's talk about some benefits of the RSI. So one of the really cool things that I like about the RSI is that it has the ability to work on all time frames. There's also a period setting in which it looks back, and those period settings are 14 days, 9 days, and 25-day periods. The stock setting for the RSI is 14 days, but other traders also use the 9 and 25 days as other tactics to assess the market. Another really cool benefit about it is that it works on all stocks, commodities, and equities, and it can also help you identify entries and exit signals into the market. It also does a really great job of identifying market sentiment when used right, and it also helps identify potential reversals. One of the really cool ways that I personally like to use it is when you're looking to identify divergence in the market, whether it be bullish or bearish. This is what I find the most practical use of the RSI, and we'll talk about that a little bit more in the following slides. Before we dive deeper, let's talk about who actually invented the RSI. So the Relative Strength Index was developed by a guy named J. Wells Wilder, and he published this in his 1978 book, New Concepts in Technical Trading Systems. It's quickly become one of the most popular momentum indicators for technical analysis today, and he also developed some other indicators as well, one of them being the ATR, average true range. For all you mathematicians out there, let's take a look at the math and see how it's broken down. So the RSI calculation formula goes like this. The RSI equals 100 minus 100 divided by 1 plus RS. RS equals relative strength, and that is the average gain divided by the average loss. The average gain is the average of all up moves in the last X price bars, and the average loss is the average of all down moves in the last X price bars. We talked about in the previous slides that the typical stock RSI setting is 14 days. So in this example, it would be the average of all up moves in the last 14 price bars, and the same thing for the loss. So how is the RSI calculated? So to get the values for the RSI, I've included this chart on the right, which I'll also include in the description, and you can break it down for yourself and see how the RSI works if you really want to get into the nitty-gritty of things. So what you'll need to do to calculate the RSI is essentially calculate the up gain and loss moves. And how you get those is that you essentially subtract the current closing price by the previous day's closing price. What you'll notice in this diagram is that the columns to the right here are empty. And the reason why they're empty is because the RSI looks back 14 days to essentially get its first value. So in this example, the first value that you'll get is essentially on the 15th cell, which you see here, because we have to calculate the last 14 days to get our first value on the 15th day. And how you do that is you take the sum of all the gain moves in the last 14 days to get your first value here. And then you do the same thing for all the loss moves, you add them all up, and then you divide them by 14 days to get your average loss. Once you've got the average gain and average loss moves, to calculate these and get the relative strength, you'll need to divide both these numbers, and then you'll get your relative strength value. Once you have your relative strength value, you use the original formula which we talked about. And that is 100 minus 100 over 1 plus RS equals 2.39, which is our value in this example. Now, if you remember old school grade 3 math called BEDMAS, and in BEDMAS you have to calculate the brackets first before you calculate the rest of the equation. So in this example, what you'll do is you'll calculate 1 plus 2.39, and that'll give you a value of 3.39. Once you've done that, you take 100 and subtract it by another 100, and that'll give you a value of 0. Then you take 0, you divide it by 3.39, and that will give you your RSI value here. You do this for the rest of the days going forward, and then you'll be able to chart your RSI as you move forward through all the closing prices. And that's essentially how the RSI is calculated. Alright, let's take a look at some examples of how we can use the RSI to scout for possible entries and exits in the market. In this example, we'll look at Apple's daily chart, and each candlestick represents 1 day's worth of price action. So let's take a look at some quick examples of what oversold, overbought, and divergence on the bullish or bearish side. So I've highlighted a few quick areas of where we can see the RSI in the oversold range and in the overbought range. As you can see in this particular scenario here, we can see that the oscillator has continued to move to the downside, getting below our 30 mark and in our oversold territory. When prices and the RSI are in the oversold territory, this is a good time to enter a long position as prices are due for a bounce. This is normally called an RSI oversold bounce, and you could potentially see this play out on most time frames. Now, the contrary happens on the sell side of things. We talked about when prices and the RSI are way overextended, typically the RSI will be above 70 and considered overbought. This is a good time to exit your position or enter a short position as prices are due for a pullback. And we can see in this example, prices pulled back shortly right after the RSI broke down. Now, in these examples, we'll look at divergence, bullish and bearish. In this first example, we'll look at bearish divergence. As we can see, it's pretty clear that prices are making new higher highs, but the RSI has made new lower highs. So when we see this happen, this is called bearish divergence. As prices continue to create new higher highs, the oscillator on the RSI continues to make new lower highs, thus creating divergence. When this happens, this is again a good time to exit your positions as prices are due for a pullback, and we can see what happened shortly after the climax in divergence. Bullish divergence is exactly the opposite of bearish. So what we see is prices continue to make new lower lows and the RSI continue to make new higher lows. When we see this happen, this is called bullish divergence, and it's typically a good time to enter a long position as prices are due for a bounce. And we can see in this scenario, prices rallied quite a bit and you would have gained quite a bit as well. This is another great example of bearish divergence. We can see prices made new higher highs, but the RSI continued to make new lower highs. In this particular scenario, this would have been a great time to exit your position, as we can see what happened shortly after this particular move. Okay, time to recap. Here are some things to keep in mind before you start using the RSI in technical analysis. So, when should the RSI actually be utilized? In our earlier slides, we talked about overbought and oversold conditions. These are great times to actually use the RSI to trade the markets. When we're in an overbought scenario, it's a great time to exit a long position or enter a new short position as prices are due to pull back. For oversold conditions, it's a good time to enter a long positions as prices are due to bounce or rally. Always use the RSI in conjunction with other technical indicators for confirmation of a bullish or bearish move. And unlike moving averages, which are lagging indicators, RSI is a leading indicator. It's always also helpful to use the RSI with signals of moving average crossovers, either the 200 MA over the 20 MA or vice versa. And one of the really great ways to use the RSI, which we talked about earlier, is to actually spot divergence, whether it be bullish or bearish. In my opinion, this is the most practical use case of the RSI and one of my personal favorites. Here are some final thoughts before we go. So always remember that not any one indicator is going to be your end-all be-all solution. And never ever trade the RSI in isolation. Indicators will always work best in conjunction with other indicators and trading signals. Thank you again for watching, and we hope you enjoyed the video. If you have any questions or comments, please let us know. Thanks a lot and take care.